Hey everybody, this is Paul doing a video. Today is October 28th. The market is closed. I was waiting for the market to close to kind of do a video so I can go over some different things. Wanted to kind of look at the where we're at right now. Just like what in the world is going on right now. So we have a few things. Okay, so very simple things. Very simple. We have a market rally going on right now that is ridiculous and crazy, and you have all kinds of people saying we have like tech stocks that are just not doing what they're supposed to do, even though they're posting these crazy earnings and like everything's great about them, but they're not posting the remarkable 20% growth that we saw before. And value stocks, dividend stocks, value stocks are outperforming right now, and what's going on there? Do we have this big rotation from tech to value? Do we have new leadership in the market? Okay, here's what's going on. Just ignore all that. That's what people like. When you try to make an excuse for why the market moves every day, you have to come up with something. So here you go. So that's kind of what you get. All right, here's what we got. See that right there? That is the dollar weakening. That is step one in getting back into a bull market. That needs to go down. The reason why that is going down is because of that, the intervention that Japan did. Also, the reason why the dollar was strong is because the thing right below Japan was getting weaker. It was going to like 109, and people were talking about parity, where one Great British pound could cost the same exact amount as a dollar. That's a great time to take a trip over to, London. So now that the UK has a new government, they're not talking about tax cuts, debt funded stuff type things. And what happened in the UK should actually scare every single American, because they wanted to issue debt to fund a stimulus, to do all this crazy stuff, like, boost their economy that's going into a recession, mind you. And the central bank was like, we're not going to do it. We're not playing this game again. Inflation's at 10% or some crazy number in the UK right now. We're not going to be the guys who buy your debt. The government literally had to change in the UK, and they had to pull back their entire financial fiscal plan. So just to give you a general idea of like how crazy that situation was. So what happens in that situation? Their currency strengthens. Japan also intervened with a very large amount of they bought their currency, sold American dollars, and this is the result. This entire rally is based off of the dollar. You have also, it's previously what I've said in multiple other videos. Bears love them on Twitter, but my God, do they get ahead of themselves on preaching doom and gloom in the markets. They did it for years when the Fed was kicking their teeth in. Like, they were right, but the Federal Reserve was basically keeping bond rates so low that unprofitable companies could post great earnings because they were taking out massive amounts of debt. Bears are doing that thing again where they're like, okay, well, the line on the chart tells me that we should go here, and you draw the line, and the two lines meet right here. Okay, that's great and all, but the world doesn't work like that. Consumers don't just stop buying stuff right away when the Fed raises rates. If you ask a normal person on the street, how has the Fed raising rates affected you? I guarantee probably 9 out of 10 people are going to tell you, I don't know what you're talking about. Like, maybe if you're moving or you're trying to sell a house right now, you're probably noticing that the housing market has kind of come to a complete halt. Houses are just kind of sitting there if you kind of drive around neighborhoods right now. So, recessions don't just happen right away. Our economy isn't rotating around housing like it used to. Like, housing is not this thing that's It's not like 2008 where it's like they raised these. It's not like 2008 because in 2008 and 2007 and 2006 especially when they raised rates, millions of people immediately felt that because we had adjustable rates. If you look at like Bank of Canada, Bank of England, ECB, Bank of Australia, they still, for some godforsaken reason, rely heavily on variable rate mortgages. Those are the mortgages that adjust when you raise rates. So, no kidding, like no shock, those banks are saying it is really stupid for us to raise rates because we're going to cause a financial crisis. We're going to put millions of people out of their houses. They're well aware. So you have three scenarios going on right now. First of all, earnings didn't come in nearly as bad as the Bears thought they were going to come in. And I am so happy that the Bears are getting destroyed right now because they really deserve it. They really deserve it. I have no idea what they were trying to do. I think they were trying to force a Lehman moment and crash some kind of fund and maybe force some kind of selling. I'm not exactly sure what in the world is going on with Bears, but they should know better that if nothing breaks, which is like a Lehman moment, a .com crash, then Fed rates slowly chip away at an economy over time. Because, say for me, for example, right now, if I wanted to sell my house and cash in on whatever it's worth, I wouldn't get what I think it's worth because a real estate agent would issue it for the larger amount, like whatever crazy amount, like 220, 230, some crazy amount. It would just sit there for months. So you have a lot of people that are just kind of stuck in place. So, and then also you have bond rates that are attracting money slowly away from the market. So we have a few, that's what your setup is right now going into this. Also, the second quarter GDP or third quarter GDP came in and it was positive. So I guess the recession's canceled, right? Because everybody that was screaming about recession right here should all of a sudden be talking about we're out of the recession right here, right? That's how that works. No, it was silly to be screaming about a recession right here. This is where all the bears got ahead of themselves. The Fed was raising rates. Oh, earnings are going to go to zero or whatever. Like, and then like, oh look, Michael Burry's talking about like 1931. And I did post videos basically saying that sounds ridiculous because if you literally just walked outside, this doesn't feel like 2008. 2008, when you went outside in Phoenix, there was nobody. You were the only one driving on the street. It felt like when you went into a mall in 2008, there was like one store open in Phoenix. That Phoenix Mall is there. When you went down the streets, entire neighborhoods had for sale signs in front of them. Like it was really, really bad. We're just not there. The economy's just not slowing down to that point yet. So that's what's set up this backdrop right now. So what earnings did is the best way to think about earnings that did not collapse is they put a floor under this market above 3,500. That's what earnings did right now. Is we tried to go down to 3507. They really tried to push it down. They tried to push it down to see if they could break something, and nothing broke. And this is just different people on Wall Street. I don't know who was doing it, but whatever. I hope they got destroyed on their short positions. So here's where we are. Like what's going on right now? The Dow Jones has rallied 10%, give or take a little. I'm actually about to break positive on multiple positions. There's some green kind of filling the screen if you can notice here. And like, where are we at? Like, where are we going? So right now, this market rally has every indication of a bear market rally because you have so many things that set it up. You had, the same exact thing happened right about here going into August. The Q2 GDP numbers came in and they weren't as bad as you thought it was going to be. They were negative, but then all of a sudden earnings came out and earnings were great. The Fed was in what's called a quiet period, and this is where they can't go on news, thank God, and constantly talk the market down. And then we got to here, and that's when they did that Jackson Hole speech where they were like, we don't like this market rally. this we feel that this injects money into the economy, and we want to bring things down. We want to drain money from the economy that we put in ourselves, that we caused all this. I feel like that's what we're kind of setting up for. There's a lot of people on TV right now saying, well, earnings came in really good, and the Fed is going to have to stop eventually, or they're going to cause a recession. And what does that mean? So, right now, where we're at, the Fed talks on November 2nd. That's where they decide on the 75 basis points for November. If Powell comes out and says, we think we're to neutral, we think we're getting to that point, we want to hold rates right about here, right about here in this 4.5 area, because the Fed is not stupid. They're well aware that this 10-year has gone through this 3 month, which indicates that people are really starting to get nervous. And every time that this has happened, you guarantee get a recession within 6 to 12 months. Guaranteed. Every time. Going back probably about the last 6 or so recessions, it's been very predictable. This is what the Fed looks at. People talk about the 2 and the 10-year and all that stuff. No, this is what the Federal Reserve looks at. When that goes through that's your indicator that something might be coming down the line. So that's where you kind of want to look at and know that this is a bear market rally. Now, how will we know we're maybe at a bottom? How will you know you're maybe at a new bull market? That kind of thing. First of all, the Fed needs to just pause. Just pause. Don't cut. You don't have to cut. Maybe pause. If they want to cut, that's up to them. But if they pause, we might, and that's a big might, avoid a recession. But still, you cannot leave housing in this state for too long without it starting to really affect the real economy. Because it starts to affect real people's lives. Say if you want to move because a job offered you a great job offer. Well, now you might be like, oh, I can't take that job offer because I can't sell my house. Or why would I want to get a house with a fixed rate at 7%? So you start turning down job offers. This is how economies slow over time. It's not things breaking, it's just the economy slowing over time. Also, as rates stay this high, emerging markets can't maintain these rates. They just can't. The pressure from the US dollar, even though it has weakened, is still too much. Other economies can't maintain this, so those economies slow. So you see it in the UK, you see it in the EU. We start seeing worldwide recessions start to pop up here and there, China, that type of thing. So that's why it's a 6 to 12 month type thing. Now, as I've mentioned many a time before, we could get to November 2nd. They could come out dovish and say we're holding rates right here, and the market will take off another 2,000 points. I'm telling you right now, this right here will take off probably past 4,200, past 4,300 in a big old celebration rally. But the earnings just aren't going to be there to back up those valuations. They're just not. Sorry, had to sneeze there. So the earnings just aren't there right now to back up these valuations at these much higher rates. So we're going to bounce between these areas until we start to see inflation come down. So that's the big reports that you're watching. You're watching the inflation report, and the inflation report should really start to reflect the lower house prices here at some point. Also, the longer that this stays inverted, that's just kind of sending so many red flags that something's about to happen, like something's about to break. So we're just kind of watching that right now. So where are we at right now in my portfolio? As of today, so you can see this right here, I got rid of QYLD. So that's a position that I got into in April. Actually, I got into that in March. I got into it very big in March, and it was the stupidest position play I've ever done in my entire life. I was trying to do a thing where I was like trying to maybe retire early and then try and figure out if I could balance my bills around dividends. It was a disaster. It was something that I tried at the time. It was a disaster. It is the definition of catching a falling knife because I took like a massive loss on that position. Just a horrible loss. I've made up for it and just different money I've made since then. But this rally right here has given me a chance to just get completely out of that position. Also, the thing where they keep shifting their dividend date, um, the way that they pay their dividend is based on, I don't know, this. Yeah, I've done a video on QYLD before. I got rid of it. Um, they've already paid out way more than $637 in dividends since I've had them. So it's, I don't know, it's kind of a break even stock for me. It's one of those things where it's like I take a capital gains loss, which means I get to write off some of these DoorDash profits. You know, these taxable gains on the DoorDash profits, but it's kind of one of those ones where it's just like I'm not winning or losing on that stock. It's kind of a break-even stock. Also, if you notice, I've gotten rid of MO. They reported a loss in their last quarter, and in theory, it's such a high dividend name, they should have the funds available to kind of like maybe restructure the business to maybe attract more people into more addictive habits, as horrible as that sounds. Um, I was hoping they would go bigger into like say marijuana, like and start consolidating that business. I was hoping that basically they would start basically buying up these sold off, like these very weak sold off stocks. Um, so that's what I was kind of hoping for is that they would just kind of start selling off these, or not selling, but just start buying up their competition in these areas and start kind of consolidating that entire market. But they just haven't. Um, so it's not really a stock I've ever believed in their business model. I've never liked the cigarette part of their business because I know it's very shady how they get business in international markets. So I sold that off for a profit. I got rid of it before it drops even further because it's just a dwindling business right now. Unless we get into a recession and all of a sudden sin stocks become popular again. But so I got rid of that. I got rid of QID completely. I took the QYLD money, put it into O. As you can see, this position has doubled. And so it's during this entire rally, what have I been doing? I have not added a penny during this entire rally. Um, from outside of that O position that I just added, from here to there, I have not added really anything. As you can see, I haven't really added anything new to this to portfolio. I'm just building up a cash position right now because I do believe that the Federal Reserve is going to come out and try and talk down this rally. I mean, talk down this rally in a very big way because inflation's still too high. So I have a feeling that they're just going to come out and just try and talk this back down. I don't know if they aim for a certain S&P target. I'm not sure what in the world they do. I just have a feeling that once they come out and they can start talking again, we're going to see the 2 year go back above 4.5. We might see the dollar strengthen. We might see people starting to talk about, well, instead of 50 basis points in December, they might do 75, 75. That's when you start to get really into like, they're going to intentionally break the economy. But they're at that point where they have to decide, do we want to break the economy? It's going to break over time if you keep rates this high, but they have to decide where they want their rates to be. They're out of time. They're done. Um, After this Fed meeting, by December, they have to decide this, and this is the sad part. By December, the Federal Reserve is going to have to decide: is do we go into a recession in 2023, a deep recession, or do we go into maybe like a minor recession or something like that to control inflation? And that's where we're at. And I hope they look at the data, but they have been, I don't know what they've been looking at. So hopefully we can kind of figure this out, but right now as it stands, I'm kind of saving up money for taxes, that type of stuff. I'm letting dividends reinvest. I'm maybe moving one or two positions around, but I'm trying not to add anything unless it is extremely weak. Like the MO money, for example, I think I put it into here. I bought some Kimberly Clark shares that were still down by a lot, um, and maybe some Verizon shares I bought. But I'm not really adding any positions because it doesn't make any sense. If I think the market should be closer to 3,700, there's no point in buying at 3,900. And I think the Federal Reserve is going to come out in November and just talk this down. you're probably going to see a lot of selling on these positions, especially anything that's very profitable in October. I have a feeling we're just going to repeat August again, um, where you just have this huge run up, and then the Federal Reserve just comes out and just talks it down into oblivion. You can kind of see this massive 7% decline. I really, really do expect that, and that happened in 18 days. So we'll see. The November 2nd meeting is what you got to watch, and then after that, it's CPI reports and then jobless reports. So that is kind of where we are right now. So let me know what you think in the comments, of course. And that's that's where we're gonna go from here. But leaving you on a cliffhanger, I guess, waiting for the November 2nd meeting. So have a nice day. Thank you all.